Hello and welcome. My name is Simon French and I'm Chief Economist at the stockbrokers Panmure Gordon. Today we're going to talk about the upcoming Federal Reserve meeting on the 18th and 19th of June and what that means for equity markets, bond markets, the wider economy. The reason for picking this subject, it is so central to investor sentiment right now. The big rally that we saw in the first quarter of the year in equity prices and indeed in bonds was largely the result of a very dovish pivot in the Federal Reserve from anticipating that steady pace of 25 basis points per quarter all the way through 2019. To a point where the committee has said, look, we don't see a move in US interest rates in the foreseeable future. And looking ahead to the middle of June, we get an update from the committee, the press conference, and will they start to deliver what the bond market is beginning to price, which is an interest rate cut during 2019. And I think I would cite perhaps three reasons why I think the market has got ahead of itself in terms of anticipating that the next move from the Federal Reserve, indeed in 2019, will be a rate cut. The first reason is, of course, what we've seen in recent days over the oil price. The oil price moving further north on the back of some hawkish rhetoric on Iran. What does this mean in terms of US inflation? This means that oil prices, gasoline prices in the key summer driving season will be higher than they otherwise would be. This will push through into CPI inflation in the US, currently running below 2%, but expected to tick up in the second half of the year. Now, the second reason, of course, is the ongoing trade dispute between US and China. Tariffs, as they've come in on $200 billion worth of goods, are going to be inflationary for the US consumer, add to the prices that they're going to pay. Again, this will push up the US Consumer Price Index, which is key for the Federal Reserve and their calculation as to whether they need to cut rates because of a risk that CPI undershoots 2%. If they think it's going to overshoot, I find a rate cut unlikely. And the final reason, of course, is that does actually the Federal Reserve need to cut rates at this point in the cycle given where growth is? Now, growth in the latest print, an annualized 3.2%, is above trend growth in the US economy. Also, you can see the commentary from the White House is trying to bring interest rates through mortgages, through corporate credit. That will stimulate growth in the second half of the year. And the president is undoubtedly wanting to run the US economy as hot as possible going into his re-election in 2020. And one of the key things you need to look out for is the Democratic primary. Starting in February 2020. The president undoubtedly will want the US economy running as hot as possible going into that. And therefore, the Federal Reserve, I think, anticipating that, is unlikely to cut interest rates. So we see the rate path unchanged in the US economy throughout the rest of the year.